How can two men become the richest investors on earth by doing the exact opposite things?
On one side, we have Warren Buffett, the oracle who buys companies and holds them forever. On the other, we have Jesse Livermore, a 1920s legend who made and lost millions by betting on the market's next heartbeat.
Today, we're pitting these two titans against each other. Their strategies couldn't be further apart, but if you want to protect your portfolio, you need to understand both. Let's dive in.
To understand how they think, we're using a concept we've talked about before, the three-layer cake. Basically, most people invest for three reasons: growth and value, speculation, and store of value. Now, look at Buffett's cake. It's almost entirely one thick layer, growth and value. He doesn't care about tomorrow's price. He buys businesses because he thinks they're worth more than the current price tag and expects them to grow for decades. Livermore's cake? It was a totally different recipe. His was almost pure speculation. He didn't care about storing value. He lived for the trade, often using borrowed money or margin to bet on the future.
You see, Livermore's big theory was that markets are illogical. He didn't believe in spreadsheets, he believed in human emotion, fear, and greed. To him, what a company was actually worth didn't matter in the short term. He looked for the feel of the market. He famously said the market is like a shark or an airplane. It has to keep moving to survive. For Livermore, slow growth was fine, but a plateau? That was the kiss of death. If prices stayed flat, he believed the momentum was dead, and a crash or a reset was right around the corner. He also watched what he called the giants, the market leaders. Back then, it was the railroads. Today, it would be the big tech and AI stocks. He knew that when investors started losing interest in the leaders, the rest of the market wasn't far behind.
Warren Buffett, on the other hand, completely ignores the feel of the room. While Livermore is watching every tick of the tape, Buffett is looking at three specific things. Firstly, the numbers. Is the business actually making money? Secondly, the people. Are the managers honest and capable? Thirdly, the long term. He treats daily price swings like background noise. If the business is good, Buffett stays, period.
If you read Livermore's memoirs, he describes the market as a living, breathing beast. It's unpredictable, but it gives off moods if you know how to read them. He spent his life trying to master those emotions, battling his own fear and excitement in a high-stakes contest to see who would crack first, him or the market.
Buffett is clearly the long-term winner here, but Livermore's insights into market psychology are still incredibly valuable today. So, are you a Buffett or a Livermore, or maybe a bit of both? Okay, thanks for listening. I would now like to ask Pete, our peer reviewer, to critically comment the video.
Okay, thanks, Kate. Let's be honest with ourselves. We are neither Warren Buffett nor Jesse Livermore. Warren Buffett is in a different business than the average investor. He usually invests massive amounts to gain controlling interests or board access, resources we simply don't have. Most of us don't have the time to analyze individual stocks to the level he does. Instead, many of us rely on index funds to diversify and reduce risk. On the other hand, Jesse Livermore's story is a cautionary tale about margin. He was right most of the time, but the few times he was wrong, the borrowed money destroyed him. However, his theory on market exhaustion, where a market that stops going up and becomes incredibly risky, is something we saw in the 2001 and 2008 crashes. Your video is confusing because it shows two totally different ways to invest, and both investors still became among the richest men in the world. Maybe that's what makes investing such a fascinating subject once you get into it.
Thank you, Pete, for your insights. I would just like to add that, as always, this discussion is intended for informational purposes and should not be regarded as investment advice. I've summarized this entire 30-video series into a book available now on Amazon via the link in the description. It covers the slow elevator rule and demand pull theory in much greater depth than a single video can allow, providing you with a complete background for your investment journey. After you grab the book, I recommend checking out our next two sessions linked on your screen. We'll be applying these theories directly to the 2000 and 2008 market cycles, so you can see exactly how these patterns played out in real time. Thanks for watching, subscribe for more, and I'll see you in the next deep dive. Thanks for watching, and I'll see you in the next video.